F.N.B. Corporation's Q2 2026 earnings are officially out, and they absolutely beat consensus across the board. We're looking at a record revenue print of $462.7 million.
Right, with EPS coming in at 42 cents per diluted share.
Exactly. And looking at the forward guidance, management is locked in for mid-single-digit growth in both spot loans and spot deposits for the full year.
Yeah, though they did note they expect non-interest expense to hit right at the high end of their $1.01 to $1.02 billion range.
Right. But, I mean, the stock reacted exactly how you'd expect. It caught a really nice bid this morning on those top-line beats.
Oh, totally. The market clearly liked what it saw.
Yeah, so today we are doing a deep dive into how a regional bank is printing record profitability during, a really deeply complex macroeconomic cycle. We're going to tear into the segment performance, the margin mechanics, the credit risk, and figure out exactly how this balance sheet is constructed.
Well, the absolute dollar figures obviously capture all the headline attention, but the core narrative here, it's really written in the profitability and efficiency ratios.
Right.
Return on average tangible common equity, the OATCE, that printed at 14.1% for the quarter. And honestly, more importantly, tangible book value per share grew 9.9% year over year.
Up to what, $12.24 now?
Yep, 12.24. And when we evaluate bank performance, isolating that tangible equity generation tells us how effectively management is just compounding raw value.
Stripped of all the goodwill and, intangible filler.
Exactly. Generating near double-digit TBV growth in a really volatile rate environment like this, it requires a very specific alignment of asset yields and liability costs.
Well, and I want to look at how they are actually deploying that capital, right? Because the balance sheet isn't just sitting there static.
No, not at all.
The Q2 print shows they executed a $47 million share repurchase. They took 2.7 million shares off the table at an average price of 17.46.
Right.
Returning capital is a pretty standard lever, but doing a buyback at that volume while also reporting record revenue, that signals a really distinct management posture.
Yeah, it's a deliberate utilization of excess capital. Since 2009, they have returned $2.4 billion to shareholders.
Wow.
Yeah. When a management team authorizes share repurchases like that, they are basically screaming that buying their own stock yields a higher return on capital than, deploying those funds into new loans.
Right, because it shrinks the denominator. The outstanding share count drops, which just inherently accelerates the earnings per share for everyone left holding equity.
Exactly. But to really fully contextualize this quarter's position, we have to look at the structural runway that actually brought them to this $50.2 billion asset base.
Yeah, that timeline is crucial.
Yeah.
The sources really frame this quarter not as some, isolated lucky victory. It's the mathematical outcome of a strategy they set in motion way back in 2009.
Right.
Because back then, F.N.B. was sitting on just $8.7 billion in total assets. Growing from $8.7 billion to over $50 billion in 15 years is wildly aggressive. It's like watching a local indie band that systematically grew into a stadium-selling act over 15 years.
Mm-hmm.
They didn't just get one lucky hit. They meticulously built this massive fan base without losing their identity.
I like that analogy. And in the regional banking space, you typically only see that kind of rapid scale achieved almost entirely through M&A activity.
Right, just buying up smaller community banks and bolting on their ledgers.
Exactly. But the data here indicates that over 50% of this asset growth was entirely organic.
But really? Over half was organic.
Yeah. And achieving over 50% organic growth on a baseline that large, that requires a serious structural advantage. Organic growth means you are actively stripping market share away from your competitors.
You're hiring commercial banking teams who can literally pull their legacy clients over to F.N.B.
Right. You're opening branches in new MSAs and actually winning the deposit war on the ground. Expanding organically across what is now a 7-state footprint means their core product offering is inherently competitive on its own.
Which brings us perfectly to the actual mechanics of their revenue generation in Q2. Because they run this two-engine model, let's isolate the first engine, which is net interest income.
Okay, NII.
Yeah. So NII came in at $365.7 million for the quarter. But here is where the math gets a little complicated, and I really want to push on the mechanics here.
Sure.
The Fed has lowered the target rate by 175 basis points since August 2024.
They have, yeah.
So, wait, I thought regional banks just take deposits and make local loans. If interest rates are dropping that drastically, Shouldn't their profit margins be taking a massive hit right now?
In a standard asset liability model, yes, a rapid drop in the Fed funds rate completely compresses a bank's profit margins.
Because the floating rate commercial loans reprice downward immediately, right?
Exactly. But the deposit costs tend to be super sticky. Yet, if you look at the report, FNB reported a net interest margin, their INIM, that was perfectly stable at 3.25%.
Okay, so how does a regional bank defend its margin against a 175 basis point headwind?
It comes down to really aggressive, highly synchronized liability management. To offset that downward pressure on loan yields, a bank just has to act ruthlessly on its cost of funds.
Right.
The data shows F.N.B. actively negotiated their borrowing costs down by 50 basis points, and they managed to push their interest-bearing deposit costs down by 30 basis points.
Well, walk me through the actual execution of that on the ground. I mean, you can't just call up every depositor and demand they accept a lower yield without risking severe deposit flight.
No, definitely not. It's a multifaceted approach. So first, it involves actively managing wholesale funding.
Okay.
You allow your higher cost short-term borrowings, like from the Federal Home Loan Bank, to just roll off. And you replace them with cheaper funding or just fund them directly with core deposit growth.
Right, that makes sense.
Second, it requires tiered deposit repricing. You immediately lower the promotional rates on high-yield savings accounts and CDs the moment the Fed signals a cut.
Yeah.
And if your core commercial relationships are deeply embedded, which we will definitely get to when we analyze their tech, you have the pricing power to lower yields without those clients immediately moving their operating accounts somewhere else.
Right, so maintaining a 3.25% margin in this environment proves their liability beta. Like the speed at which they can lower deposit costs relative to the market is just exceptionally well calibrated.
It's basically a masterclass in liability management.
But liability management alone doesn't generate record total revenue.
No.
We have to look at the second engine, which is non-interest income. Fee income totaled $97 million for Q2. That's a 6.6% sequential increase from just the prior quarter.
Right.
And the presentation notes that since 2015, they've built 10 distinct multi-million-dollar business lines. Right. Resulting in a 9% compound annual growth rate in non-interest income.
And this right here is the shock absorber for the entire franchise. Because net interest income is inherently cyclical. It lives and dies by the yield curve. But non-interest income, fee generation from wealth management, insurance, and particularly capital markets, that is far less dependent on the Fed funds rate.
Yeah, and the presentation highlights that capital markets revenue alone has actually more than doubled since 2015.
They are heavily emphasizing their expansion into Wall Street territory now. In 2026, they officially rolled out full investment banking and public finance capabilities.
Which, I mean, for a regional bank, spinning up a true investment banking arm is a massive undertaking.
It's huge.
So why take on that kind of overhead instead of just sticking to traditional middle market commercial lending?
Because it captures the full life cycle of the corporate client and it completely stops fee leakage.
What do you mean by fee leakage?
Okay, imagine a mid-sized manufacturing client that has banked with F.N.B. for 10 years. If that client decides to acquire a competitor, they need advisory services. And they need to syndicate a massive loan that is way too large for F.N.B. to hold entirely on its own balance sheet.
Right, so historically, that client would have to hire some mega bank in New York to handle the investment banking side of the deal.
Exactly. And F.N.B. would lose out on all the advisory fees and the syndication fees. But by bringing investment banking and public finance in-house, F.N.B. captures that highly accretive fee income.
Oh, and those fees drop straight to the bottom line?
Yep. They don't require the bank to hold heavy capital reserves against them, which directly drives up that 14.1% ROATCE we discussed earlier.
Public finance is a really interesting addition this year, too, because underwriting municipal bonds and providing advisory services for local governments, that provides a totally counter-cyclical revenue stream.
It does. Municipalities always need to fund infrastructure, regardless of whether the broader economy is in a recession.
Right, it diversifies their revenue base away from purely corporate exposure. But, speaking of exposure, I do want to pivot to the risk side of the ledger now.
Sure.
Because record revenue is completely irrelevant if the loan book is deteriorating underneath them. So let's look at the provision for credit losses. In Q2, they set aside $21.4 million, which is a $2.9 million sequential increase from the prior quarter. And as an analyst, a rising provision expense often signals that management is seeing early warning signs in the credit portfolio. So I have to ask, if the bank is performing so well, Why are they setting aside more money for credit losses? Is there a red flag hiding in these numbers?
It's a great question, and it's a critical metric to isolate. But under the current expected credit losses methodology, or CECL, banks are literally required to provision for losses based on forward-looking macroeconomic forecasts, not just actual realized defaults.
Right.
So when you see the provision increase to 21.4 million, you have to separate the mathematical modeling from the actual idiosyncratic health of their specific loans.
Ah,
In a volatile geopolitical environment, CECL models will automatically demand higher reserves, but to see if the portfolio is actually cracking, we have to look at the lagging indicators, the loans that are actually failing today.
the net charge-offs,
Yeah.
the actual realized losses.
Precisely. And despite the increase in forward-looking provisions, actual net charge-offs for Q2 were incredibly suppressed at just 0.19% annualized.
Wow.
Yeah. On a total average loan and lease portfolio of $35.5 billion, 0.19% is negligible.
It's essentially a rounding error.
Right. It indicates that the 21.4 million provision is purely a function of conservative balance sheet management and macroeconomic modeling overlays, rather than a reaction to some sudden wave of localized defaults.
And I'm also looking at the early stage distress metrics here.
Yeah.
Total delinquency across the entire portfolio actually dropped 3 basis points down to 0.71%.
Yep.
And the ratio of non-performing loans and or REO, the other real estate owned, to total loans compressed down to 0.31%. So we have this dynamic where management is putting more capital into the reserve bucket while the actual volume of late and non-performing loans is shrinking.
It implies a highly defensive posture.
But I want to understand why the credit quality is holding up so perfectly well when the commercial real estate and broader business lending sectors have been under immense pressure nationally.
The resilience of the portfolio is completely dictated by their originations. F.N.B has maintained a really rigid focus on traditional middle-market commercial and industrial lending.
Okay.
A key data point in the presentation is their exposure to non-depository financial institutions, or NDFIs.
Which is basically the shadow banking sector, right?
Exactly.
Lending to private credit funds, mortgage originators, specialty finance companies, that sort of thing.
Yes. And NDFI balances make up just 1.6% of F.N.B's total loans, which management makes a point to note is well below peer and industry medians.
Wow, 1.6% is incredibly low.
It really is. NDFI lending can generate rapid loan growth, sure, but it involves leveraging entities that are themselves highly leveraged and extremely sensitive to liquidity shocks.
Right, it's risky.
Very. By capping NDFI exposure at 1.6%, F.N.B is purposely avoiding the higher yield, higher risk shadow banking trades. They are lending to real operating companies with tangible cash flows and hard assets.
Right.
And that conservative origination philosophy is exactly why charge-offs remain at a 0.19%, even after 175 basis points of rate cuts and all this broader economic turbulence.
That makes perfect sense. Now, funding that $35.5 billion loan book requires us to examine the liability side again, specifically the deposit base. You cannot run a lending engine of this size without a stable, low-cost deposit foundation.
No, it would collapse.
Right. Average deposits for the quarter reached $38.7 billion, which is a 4.1% year-over-year increase.
Yeah.
But the absolutely vital number in this entire earnings release is the composition of those deposits.
No, for sure.
26% of their total deposit base consists of non-interest-bearing demand deposits.
That is the structural advantage that makes the 3.25% net interest margin possible. I mean, over a quarter of their funding costs them absolutely nothing in interest expense.
Nothing. It's wild.
And maintaining that mix at exactly 26% for 7 consecutive quarters, especially through a period where clients have been hyper-aware of yields and shifting money into money market funds, it's just incredibly difficult to execute.
I always describe non-interest-bearing deposits as just free fuel for the bank's lending engine.
That's a great way to put it.
Because in a rational market, corporate treasurers and high-net-worth individuals, they do not leave billions of dollars sitting in zero-yield accounts unless they are receiving a massive offset in operational values somewhere else.
Right.
So what is the mechanism keeping that 26% locked in place?
The offset is the technological infrastructure.
Okay.
The earnings presentation aggressively highlights their investments in digital capabilities, data analytics, and artificial intelligence. They specifically point to their e-store platform. Commercial clients maintain large, zero-yield operating balances because the bank's treasury management software is just deeply, deeply integrated into the client's daily operations.
Oh, so it is an ecosystem play.
Completely.
If F.N.B's APIs plug directly into a mid-market company's enterprise resource planning software, and they're automating their accounts payable and receivable, and utilizing AI to forecast daily liquidity needs, the friction of ripping all that infrastructure out is enormous.
Exactly. The CFO of that manufacturing company is not going to tear up their entire accounting workflow just to move an operating account to a competitor offering like 50 basis points more on a sweep account.
Right. The technology acts as the retention mechanism.
The convenience and the efficiency become the yield. This omni-channel integration across their mobile, digital, and physical branch networks creates intense deposit stickiness. But building and maintaining that technological moat is highly capital intensive, which directly informs the forward guidance that management provided.
Let's analyze that guidance, actually,
Right.
because they are projecting mid-single-digit growth for spot loans and spot deposits for the full year 2026.
Right.
But they explicitly noted that non-interest expense is expected to run near the absolute high end of their $1.1 to $1.02 billion range.
Yeah.
And as an analyst, seeing expenses pushed to the ceiling of the guidance range usually triggers immediate scrutiny regarding cost control. Wall Street does not like runaway expenses.
No, they don't. And if the expense growth was driven by administrative bloat or just poor efficiency, it would be a glaring red flag.
Right.
But management is deliberately tying this elevated expense run rate to continuous investments in tech, data infrastructure, and scaling those new capital markets capabilities.
Oh.
They are making a strategic trade-off. They're willing to absorb higher non-interest expenses today because funding the data analytics and AI tools is literally the only way to protect that 26% non-interest-bearing deposit base tomorrow.
Because if they cut tech spending just to artificially suppress their expenses and make the quarter look pretty, the free fuel evaporates, their deposit costs spike, and that beautiful 3.25% IM completely collapses.
Exactly. It is a highly calculated defensive spend.
Wow. So when we really synthesize all the components of this Q2 print, the 148.7 million net income, the 14.1% ROATCE, the aggressive expansion of fee-based investment banking, and that rigid 0.19% charge-off rate, the narrative really solidifies.
It does.
We are not looking at a bank that merely survived the recent rate volatility. We're looking at a 15-year architectural plan that purposely designed a balance sheet with enough diverse revenue streams and technological lock-in to just absorb massive macroeconomic shocks.
The defining characteristic of a successful financial institution in 2026 is the ability to decouple profitability from the whims of the yield curve.
Right.
And F.N.B has demonstrated that by leveraging a true two-engine model. They manage the spread income with extreme discipline on the liability side, while simultaneously rapidly scaling sophisticated fee-generating business lines that are totally immune to rate cuts.
The strategic evolution here really forces a reevaluation of how we categorize these institutions.
Yeah.
I mean, think about it. When a regional bank successfully deploys artificial intelligence for corporate treasury, utilizes advanced data analytics for risk modeling, and scales an in-house investment banking arm to syndicate major corporate debt.
Right.
I mean, those are services historically siloed in the glass towers of global financial behemoths.
Right. The trillion-dollar club.
Exactly. So it really begs the question for you to mull over as an investor. Is the traditional dividing line between a Main Street regional bank and a global megabank beginning to permanently disappear?
It's a fascinating trend to watch, for sure.
It really is. The definition of a regional bank is changing, and this balance sheet is the proof of concept. Make sure to follow the show for our daily earnings coverage and continuous deep dives into the financial sector.